securities is that during the life of this, during this 8-period period, this is the face value, par value of the bond. It will be issued at par and will be redeemed at par by the issuer, whatever, let us say, company is there, corporate. In this period, this value may go up and down. For example, it may become 1,100, it may become 990 if it is a secondary market. So during this period, the value of the bond may fluctuate. As you will see in the fourth unit, why this fluctuation takes place, that there is a reason. Because if the similar kind of bonds are there in the market, like, with the similar feature, and this bond is providing 10% rate of interest, and if other bonds are providing high interest rate on with the same investment, 12%, naturally this price of this bond should go down so that the holders are compensated if they buy these bonds. But it will never be the case that, at the time of maturity, redemption period, the issuer will pay more than this. Like this idea that a bond issued at par and redeemed at premium are like this is complete nonsense. Some fictional tip. So it is not that. This does not exist at all. So there is even not a theoretical possibility. Only theoretical or fictional. So with during the life, the price may change, but when the time of maturity will come, it will be redeemed at par only. So as I told you, there is a link between rate of interest and the price of bond. Details you will study in the fourth unit. There is inverse relationship between price of a bond and the rate of interest. So let me repeat. The fixed income securities, they carry a fixed predetermined rate of interest or return. They are issued at par and redeemed at par. They have a maturity period. Holders of these securities, they are the creditors of the company. Now, with these brief idea about, yes, you will get in later on. Some of the advantages are, it is given here before I, like, those who make investment, they can get a assured rate of return and unlike equity. In case the company defaults in making payment, these bondholders they receive the payment first before others are paid. So they have the preference over that. But one major disadvantage is that these are fixed source income, like interest is there. So if a company is making profit, then the upside potential for profit is limited. For example, unlike equity investment, where the return may be higher than, there is no fixed obligation, but like that. So given this, let us move to further and try to understand bonds which are issued for long term. Like some bonds are, like corporate bond, government bond, convertible bond, and mortgage bond. Now here you should take into account the two important terminologies: capital market bond or fixed income securities and money market. The distinction is that if the investment is for more than 1 year, they fall under the capital market. If it is less than 1 year, then these are clubbed under the money market securities. So this is the distinction. So these bonds are more than 1 year, so therefore they are capital market securities. So some bonds are like a company may issue a bond, corporate bond, government may issue a bond, and there are some type of bond which have got a backing of mortgage. I will explain to you what we mean by mortgage. Like housing loan may be there. Now this housing loan can be pooled and then can be made in the issued in securities, by certain denomination. They are pooled, sliced and diced and sold off. And then there are certain bonds which are convertible bonds, that is, after certain period, if issuer of a bond, will be has got the option that it can get converted into equity shares. So the pro rata, it is defined. That is why the word is convertible. They will not remain bond fixed security obligation forever, but after certain period they will get converted into. So the companies issue bond, government also raise fund, and so on and so forth. So like the company may need funds for raising the investment and others, plant equipment, and sometimes takeover also. Sometimes companies they take loans. This is called leverage buyouts. We use debt to take over the companies. LBOs they are called. So they can, but for investment and other purposes, they can buy. The important thing is that the interest payment are tax deductible. So other dividend payments are not. So whenever the profit before taxes, profit minus interest payment, then taxable income arises. So it is also a attractive feature. So that is why the bonds and the fixed obligation, but it is risky also for a company. That if you are using too much debt, then company goes bankrupt, then the obligation may be more than. So there is a chance that too much leverage, too much debt can also be risky. So it's a double-edged weapon. You can take advantage of tax shield, but at the same time, company can also be risky. Like the famous Modi-Gillani-Miller hypothesis, which may have studied, how a company divides its capital structure into debt and equity, how much in debt and how much in equity, and leverage form, unleveraged form, and they like that. There is no optimum level of debt, but too much debt is considered to be very risky. So this is then in the bonds also, there are ratings, like CRISIL and other. Fourth unit we will discuss this thing. Like some rating agencies are there which they rate the bonds, AAA, BB, the investment grade, below investment grade, and so on. Now, so in terms of safety, whether if somebody is making investment in those, how safe it is, so that is why the ratings are provided, because it is a fixed obligation. So that is why because depending upon economic conditions and other conditions, the company may not be able to pay back. And one quality of the type of bond is known as junk bond. Junk bond are below investment grade bonds. So it is very risky. But when it is risky, then it also provides high interest rate. So means below investment grade, but that is the word junk is there. So in terms of credit rating, it is the lowest. So yet if you want to attract the investor, one has to offer high, because higher the risk, more the return will be required by the investors. There are some bonds which do not carry any coupon, any interest rate during the life. They are called zero coupon bond. So whatever bonds I have discussed till now, I am just postponing this mortgage back. I will explain to you after this. So the zero coupon bonds are there which do not provide any interest payment during the life. For example, if a bond is issued and it is redeemed after 10 years, so it will not provide any rate of interest during this period. So zero coupon. Coupon is the rate of interest on the bond, to be paid to the bond holders. What happens that when this type of bond is issued, then it is issued at below face value. If 1,000 rupee bond is there, then it will be issued below this. Let us say 800 rupees. 800 rupees, it will be issued here, and it will redeem at 1000 rupees. So the difference is the 2000 rupees which is paid by the issuer is the during this period may take into account the interest payment and like that. So they are issued at below face value, redeemed at. So, but by and large, we find that the majority of the bonds are issued at coupon bearing. For example, in India, in early 90s, when the rate of interest was very high, 14, 15%, IDBI came with a bond of you invest now 2700 rupees. After 25 years, you will get 1 lakh. In a 2700 investment, will fetch you 1 lakh rupees after 20. You may say that this is a big amount, but you can understand that rate of interest prevailing is 14%. So it will not take more than 5 years for this money to get double, in 5 years and then 25 years, so it means that the 27 will become 250. Then after, if it is continues like this thing, then again, so another 5 years, and then you do so. It was 14, 15. So that was the effect of compounding. So, but what happened that the bank actually redeemed this bond before this. They had an option that they can redeem back. So all those who had deep discount bond, they were redeemed by the company. They were retired because the rate of interest, went down, and therefore the company found it. The bank thought that it will be costly to them to pay very high interest rate when they can issue new bonds at a lower interest rate. So now one feature of bond which I just mentioned there and I did not explain is called mortgage backed bonds or securities. The word mortgage are collateral, that in case something happens, then one can sell off and can recover it. Okay. Like, let me give you an example that housing loan is provided by bank. Now there may be, let us say, 100 of borrowers, the loan takers. Let us say that on an average they have been provided 10 lakh each, multiplied by 10. Okay. So total, let us say a bank ABC has provided just loan to. Now why this? Because they are for the housing. Therefore, in case the payment is not rate of interest and final the principal amount is not paid by the, so one can sell it. So it can have backing of. Now, in this type of bond, what happened that the companies, the banks, what they do that they pool this. If you multiply by this the total amount, rupees, the 100 and multiplied by this, so the total amount. Now, if you see that, and when they pool, they package it, pool this total loan. Now, what they will do is that they will convert these loans into securities, which they can sell off to other investors. So it has a backing, it has a backing of housing loan. So what they do that they pool it, slice it, dice it, and then sell off and it makes it tradable securities. This is known as securitization. Now, so naturally, behind this is that, for example, if the banks are charging 10%, so bank may now take 1% of it and pass on the rest to those who make investment, because the denomination of this amount, nobody will buy 10 lakh for 10 lakh each loan. So they make it in marketable security denomination, and therefore investors. Now the classic example of mortgage-backed securities and why is of recent financial crisis. When the housing loans were provided, by the banks to. And what happened that because you know that those people who were provided housing loans, they were below, they were subprime, meaning they were not prime borrowers. Their ability to pay back was low. But the scheme that everybody should be providing, high bank were getting a lot of interest on that, and therefore they were passing on the loan to the borrowers without doing due diligence. And because of the securitization, what the bank did? Banks sold off these loans to the third party, which converted into marketable securities and sold off. So just remember that if this pool is drawn from these 100 people, so not all of the high quality borrowers. So if they default, so most of them if default, naturally it will affect those who have made investment here in terms of security. So that is why when these people who were not of high quality, they defaulted, naturally it created a chain effect in the economy because of this. And this loan mortgage-backed securities was the trigger point of the financial crisis of 2008. Mortgage, because the bank, because they were making huge money out of these loans, so they were taking some certain cut and then passing on. And then rating agencies were there. They were rating this loan, AAA, very high quality. So they were also commission agent type. They were taking commission and pass on to other. And then pool it. And then they were mixed with other securities. Yeah. So create a new kind of synthetic product, financial product. So in India also actually ICICI Bank and other banks, they have also made investment, but that investment, because the investment was across the globe, therefore it created a chain effect. And with the start with the Lehman Brothers and others, the US financial, the crisis erupted. But as I said, that it was caused by the mortgage-backed securities. So this is similarly student loan also are there, which can also be packaged. Credit card payments due, they also pooled. And like the idea was that if the banks have got this in their balance sheet, then naturally what will happen that they may not be liquid, so therefore they sell off too. But in the old time when bank cannot securitize it, they will make a due diligence. Who is the borrower? What is his credit worthiness? So what happened that when the quality of borrowers was so low that some people who did not pay, the loan back or interest payment, they just put the key in to the banks and then they went away. So it was called NIJA, neither income nor job. They were also provided loan by the bank because they were making huge amount of interest on these loans. So this is called mortgage-backed security. And any security, any bond which has got the backing of certain collateral, it may be the housing loan, it may be student loan, it may be credit card payment. They can be pooled and like this in this way. So this is it is given here. So let us go further. Some bonds, that I have already hinted at that, because when I was giving example of IDBI Bank, I told you that IDBI had issued a bond, but it has a feature which is called callable bond. Callable bond, simply I will discuss this in the last part of derivative securities. Callable means it gives the right to the holder, issuer, to redeem the bond before the maturity. Like 27 years was the bond for which RBI has issued at the already, but it has a feature that it can call back, it can redeem before this. So this is called callable bond. This terminology has been derived from two words of call and option, call option, put option. These are terminologies of bonds. So sometimes, so A bond that cannot be redeemed before maturity is called bullet bond. You cannot redeem before, let us say, 25 years, 10 years, 15 years. During the life of the the maturity period, it can be redeemed. So that callable bond, because sometimes why this feature is included by the issuers, the reason is that the issuer may think that the rate of interest may undergo a substantial change. So either they think that the rate of interest paid now is higher, therefore they think that it will be better that if we can put this feature, a clause there, so that we reserve the right to buy back before that. Convertible bond, I have already explained to you that it provides that the bondholder will receive. It may be the one bond, to corporate security, whatever it is specified, that those holder want this to through that two common stocks or three, whatever is specified there. That after that period it will be converted. Now the fixed income securities, we also find in money market. As I told you, the distinction between money market and capital market securities are that it is usually less than 1 year. Usually, I'm saying, now by and large, maybe slightly. So all those securities which have a maturity period of less than 1 year, they fall under money market securities. And some of the fixed income, which provides fixed return, fixed rate of interest, securities are Treasury Bill, commercial paper, certificate of deposit, and repo rate. So we'll go through these one by one to understand. Now, Treasury Bills are issued by the government. Government, for example, Government of India, RBI, on behalf of the government, raises funds. Naturally, when RBI raises funds, the government needs money. It may have to deficit in the budget. So in order to meet the financial obligation of the government, the RBI can float it. And the maximum, 364 days, 91 Treasury Bill days, Treasury Bill, 181 days, Treasury Bill, 364 days. So that these are. Now, these Treasury Bills are very safe because they are issued by the government, by the RBI and the government. Therefore, they are the risk-free, almost virtually, because government usually do not default. Corporation may default, but these Treasury Bills are issued at a discount. Whatever par value below par value. So, and no interest is paid. For example, in 91 days, it will be redeemed at the par value, but it should. So that will the redemption at the par value and the issuing at the below this par value will cover the rate of interest, what we call it. So this is called, as you will see in third unit, that these Treasury bills, they are called risk-free almost. But also there is a risk also, means inflation is high and the rate of interest provided. But in terms of the ability to pay back, it is virtually risk-free. There is no default by and large by the government. Some government have made a default, like Latin American countries. Greece was on the verge of default in recent times, was bailed out by the European Union. So the yield, the below face value and redemption rate is called yield. It is implicit yield. Now, what the government does? Government sells through auction. These securities. Like in auction, what happens that the auction goes to the highest bidder. Like if somebody bids at 12 rupees, let us say, other bids at 10 rupees and then 9 rupees. It's an example in auction. So the highest bidder will be, given will be allocated whatever goods and services, whatever. But in the case of Treasury Bill, so government invites the bidders, those the financial institutions and others, those who participate here, and they quote a rate of interest on it, that how much they will be willing to charge for this, and they also specify the amount, that how much they are going to subscribe. So now what the government will do that government not like this, that government will start with the lowest rate of interest, those who are going to charge lowest, because if they give to the highest one, so they will be paying high interest rate. So the lowest in terms of the rate of interest will be given the first allocated and the amount which they investment, and then they will go on. Or in some cases, then non-competitive bidding average is taken, and then we start with the lowest, and then the goes on, and then the subscription is complete, because there is amount also which government wants to raise. So that amount. So this is how through auctions, and it is a regular feature that which is carried out by the RBI to raise fund for the government. It is given here, 91. Now, one more important instrument, financial instrument for short-term fixed income is commercial paper. Commercial paper, is short-term borrowing. It is for the large, big companies, which are reputed companies, high-rating companies. So one option may be there, that these companies can go to bank for short-term loan. They can also raise. You understand that for working capital, short-term. Unlike bond, which are for long-term. Okay. So they may need cash and they may go to bank can charge. But certain companies, they instead of going to bank, they raise money from the market itself through commercial paper, because these are the high rating companies, therefore they are able to get loan at a lower interest rate than what is charged by the bank, because it is cheaper for them. So that is why what has happened in India in this, and these are unsecured, means that secured loans mean that if a company default, so one cannot take recourse to the collateral, that one can sell off the assets of the corporation and can get the back money. So it's a risky also, but that in recent time, most of the high rating companies in India, large corporation, they are even for short term borrowing, they are resorting to commercial paper and directly from the market. So they are bypassing the banks. When they are bypassing the banks, to all those the borrowers from the corporations also, they are not very good borrower in terms of credit rating. So the B class, C class type, they are going to bank. So their portfolio is also, of banks, the borrowing is not of high quality, and therefore there is a lot of default as well on account of that. So this is also a big change which is coming. I'm sorry, there was a disruption because some important call was there. So I'm sorry that let us carry it forward. So what I was explaining that because now even short-term borrowing, the companies are bypassing the bank. So there is a call disintermediation, Uh, so banks are left with the low quality borrowers, and that is why. So this is one way of raising funds by the corporation commercial paper. So the maximum duration of these is, you see, as short as 7 days to 1 year maximum, and they are sold at discount and redeemed at par. Whatever the face value, and they will be issued at below that, and the redemption at the face value will be the rate of interest will be yield on that. Then another instrument which is used for raising short-term fund is called CDs, and it is issued by the banks and other financial for specified. So 7 days to 1 year. So financial can also issue 1 to 3 years, and again CDs are issued at discount on face value on a floating rate basis. Floating rate means that the rate of interest may fluctuate with certain fixed and plus the prevailing market rate. Now this form of investment is most popular because it's short term by mutual funds and others. They make investment here. And the beauty of this instrument is that the denomination is not fixed. Any denomination can be tailored according to the needs of the investors. Like in marketing, we say find out the needs and wants of the consumer and develop a product tailor and for this. So suit the needs of the investor. And they are generally risk-free and they offer higher interest rate than the Treasury Bill. And they are transferable also. So if somebody is holding B, he can transfer it to C as well. So because of this is the very attractive method for making short-term investment like this. So this is another short-term security which is used by the first raising the fund. Then there is one more method by which short-term funds can be raised, which is called repo rate. Please understand this word. This is called repurchase agreement. So it is like, something is sold and at a later on, let us say at T1, it is bought back. The word is simultaneous sale and repurchase. Sale, and here it is repurchase. Now, how it operates, let me simplify it. You know that, first also let me make a mention because it is a type of collateral loan. Collateral, you understand it. If some default is there, one can sell off. Collateralized loan. There is a backing if the borrower does not pay. You are aware that in India, all the banks are required to make investment in SLR, that is for fulfilling the statutory liquidity requirement, government or government approved securities. They have to make investment, every bank. So they have made in because certain percentage of that has to be made to meet the legal obligation. Now, what happens that banks are in need of short-term liquidity and 1 day, 2 day, maximum fortnight. So what they do that they park this, they take this in government debt securities where they have made investment. They sell to RBI. Then let us say it is worth, just an example, securities are worth 1 lakh, isn't it? So, and what RBI does, that RBI provides loan to the commercial banks. Let us say commercial banks And the RBI will not provide the full value of this thing. Rather, it will charge a rate of interest for this duration. Let us say it is 5 days accordingly. So whatever is there, so will be accordingly it will be determined. So now after this 5 days, what will happen that the amount the amount will be paid by the commercial bank, and they will buy back the securities. So it is called repo rate, the rate at which RBI provides financial accommodation to commercial bank. Is called, that is why whenever RBI signals that repo rate 0.25 or something like that, it signals that it is going to provide loan to commercial bank at a slightly lower. If it increases repo rate, then it means that the high interest rate regime is there. Now, repo rate is there when commercial bank approach the RBI for financial, for meeting very short-term financial obligation, using government securities as a collateral. Now, imagine that if you go to bank with a borrowing for collateral, bank will charge high interest rate. But if a collateral, bank will charge lower because the risk is minimized. That in case some default is there, that collateral can be sold off. Now, another terminology is that reverse repo. When RBI is in need of, then RBI can also sell off government security to commercial bank. And then after that period, RBI will buy back. So this is called reverse repo. Normally, RBI does not need, but both rates are announced. The current rate, if I can recall correctly, is 3.25 or something like that, the repo rate that for this RBI will charge you. So accordingly, for 5 days, 10 days, 15 days, so this is annual rate. So then will be charged by the amount of the loan is huge, therefore huge amount outflow of interest payment is there. So this is a very important instrument for short-term borrowing because by the banks and it is used by the banks for short-term meeting short-term financial obligations. So it is explained there in my slide. All these things are, you can go through. I will provide to you. If you have any question, you can ask before I proceed to preferred stocks or shares.
Good afternoon, sir.
Yes.
Sir, my question is.
Yes, there is something happened.
Am I audible, sir?
Yes, yes.
Oh, so my question is, in commercial paper, you told us that the money is raised from the market. So, but at an interest lower than the which is provided by the bank. So why would market will be providing a loan at a lower interest as compared to the bank, which is also risky?
Bank, that if you are raising money from the market, for the market means that bypassing the banks, isn't it? So yes, see if you go to bank, if you are high quality borrower, there is a relationship between the why rating is done. Do you have any idea why this rating is done? Based on several parameters, DB, let us say this plus like this is a high quality borrower. There is a risk of default is less, isn't it?
Yes, sir.
Therefore, if any entity which is borrowing is has got less risk, then the investors, they would like to charge lower interest rate instead of that the high. For example, this company which is coming to the market risky, there may be default, isn't it? And banks are normally they charge high interest rate because if you are buy, there is an intermediation charge also in a bank, mop up the saving from depositor, isn't it?
Yes, sir.
isn't it? If they provide depositor at 10% rate of interest, they will charge more than this. So this is called margin. This is called they get on this, isn't it? Because on the one side, because a bank is there are intermediaries, isn't it? FIs,
Yes,
they are
sir.
between borrowers and the savers. So
So,
let us
sir, the commercial paper is only provided to the companies which are having good rating.
all the companies can raise funds from the past short term. This is for that. And hereby, you know that the margin, this is intermediation cost by the banks. So this is, there is no intermediation cost. You are approaching directly. The company is directly approaching the money market. That is the players. When I say money market, those who are making investors directly. It is a bypassing. So the 2%, 3%, whatever is taken by the bank, because depositors are provided only 10%, they are charged 14%. Are you getting the point?
Yes, sir.
So this is the reason, because it's a disintermediation. You bypass naturally. If there is some middle person, it's a middleman type. You know, bank or what are intermediaries.
Yes, sir. I got it. Thank you, sir.
That is why this is the reason why you buy, when you get that charge which is given by the bank, because naturally banks will provide lower interest rate to the depositor and will charge high interest to make, and this charge is actually this difference spread, it is called in terminology. So this spread is not there. You are directly approaching. If you're high quality, you can raise funds directly from the investors. So instead of approaching a bank. Now let us go further and try to understand some other securities which are in between. In between means that they have some features of fixed and some features of equity, equity stocks. They are known as preferred stock or preference share. So here what happens that these securities, they are hybrid, fixed plus equity feature. So that is why they have some feature of equity. Like these preference shareholders, they are paid certain rate of return on profit earned by the company. And this profit which is to be paid is obligatory, 10% rate of it. Now in equity holders, there is no fixed obligation. That if a company makes profit, it can distribute it as a form of dividend or it can retain it. Earning is there. So either earning can be paid in the form of dividend or it can be retained. If it is no dividend is paid, it is expected that this retained earning will be reinvested by the company. Otherwise, they should distribute it to the shareholders. But there is no fixed obligation here in equity. Whereas in case of preference share, because they have preference, the word after debt holder fixed interest payment, the next in line is the claim on the profit is of that of, if the profit is there, then please remember the word profit. If loss is there, naturally it cannot be paid. Then the company has to pay the preference shareholder 10% of the profit, then whatever remains belong to the equity holders. Now a company can decide to pay dividend or it can retain it or plow back like that. So that is why, and these preference shareholders, they get a high, naturally, fixed dividend. They are called dividend because they are paid off profit. It is higher than the bondholders because their claim comes after the bondholder. First bondholder, then preference shareholder. And then whatever remains belong to the residual claimant, that is equity shareholder. But these people, they do not have a voting rights. Unlike unlike the equity holders. So they have not. But the law provides that if the company does not pay dividend to preference shareholder for 3 consecutive years, then these preference shareholders can go to court of law and can ask for liquidation of company so that their obligations are paid off. So, but preference shareholders are some other feature may be there that they may become the equity holders. So preference shareholders are also two types: cumulative or non-cumulative. If they are not paid, then after certain they can be paid back. But as I said that the important thing to note is that the preference shareholders comes next in the line of payment after bondholders. If whatever profit is there, the profit before tax, interest and taxes minus interest payment, minus the dividend paid to preference shareholders, and then profit after after taxes, then tax will be paid on this, and then profit after taxes, whatever you arrive at. So the preference shareholder, that is why they have preference, and another thing is that they do not get enjoy the benefit of common stock if companies capital gain type, capital gain, price appreciation. They only fix 10% profit, only that. But whereas the equity holders, not only they can get dividend out of this is profit out of the company, but the price of the shares may also go up. So both these things can be achieved by the equity holders. It can be beneficial to equity holders. Now the equity holders, in contrast, they are the shareholders of the company. They are known as equity stockholders or common stock. So the various names are there. So it represents, number one, those who hold equity. They are the owners of the company. And each share of the company, let us say 10 rupees, they demand one voting. They carry one vote, one share, one vote. So, and if you look at the return of the common stock, historically the common stock has provided the highest return. Equity stock has provided higher return, even higher than the gold and other. But they are also risky because when all are paid, they are residual claimants. They are the residual claimants. When everyone has been paid, then whatever remains belongs to, if nothing belongs to, they will get nothing. Okay. So, and they have no maturity period till the company is running, going concern is there. So like bond, there is a fixed maturity period, preferred there is fixed maturity period, and like that. But in case of equity, they are after every, but so they can either get a dividend or they can get a capital gain, price appreciation. The return comes from these two. The return means how much. So in some companies do not. For example, Google has not paid any dividend at all for a very long period, but all the returns are coming from capital appreciation. It is flying back. For example, various mature companies, they do not have reinvestment of corporate fees. So therefore, they pay back their dividends. Whereas those which have got whatever earning they get it, they reinvest. So the investors are interested in price appreciation. For example, if somebody purchases a share at 100 rupees, now it is 120. So in 1 year, the return is 20%. no dividend is paid. But if 100 rupee, 120 is the price plus 2 rupee dividend is paid, then it will be that 22%. So the capital gain, so the return comes from either capital gain or in India, for example, recently, the number of companies which are paying dividend has gone down considerably. So if it also depends upon the types of the industry where a company is operating, like IT and others, where they have a massive investment opportunities, they can reinvest, and so that is why the dividend payment may be less. So, but the investors may be interested in the return, and some people may be interested in dividend as well. Like the famous Modi-Gileni Miller hypothesis says that dividend matters or does not matter. There is also theorem of Modi-Gileni, irrelevance of dividend, whether you pay dividend or not pay. What the investors are interested in return, total return, whether it comes from dividend or it comes from the price appreciation. But it may matter to some people who would like to receive a constant stream of payment, but by and large, the return, the shareholders may prefer the total return. So these are some of the features of common stocks, which is explained here. Stock dividend, and sometimes it happened that company, instead of paying cash, it issues additional shares as well. Okay, bonus shares. That if you are holding 10 shares, 100 shares, maybe 5, there will be a basis of issuing 5 shares, maybe additionally. So issued also. And what has happened over the years, like big companies like Apple and others, they have got huge cash. So what they are doing, that they are buying back their own shares. Share repurchase they are undertaking. This is also a situation where instead of making further investment, they are trying to buy back their so that the price of the share, because if you are buying back the shares, then the number of outstanding share goes down. So it increases the price of the shares, equity stocks. So you are retiring by using cash. So it depends upon how you try to depends upon the corporate strategy of that company and like that. But in very short, the equity stocks are the provides ownership. The return may come in the form of dividend or capital gain, and they are the residual claimant. They are risky than other type of instrument, and the mature companies may provide dividend because that they do not have, but the growing companies may reinvest it. So these are some of. And share buyback, I've already explained to you. Company when buy back the share repurchase. You will get sometimes if you look at the newspapers, what comes ex-dividend. If you leave the quote, it means that if you buy the share of the company, you will not get the share because the dividend, because the company may have distributed and the earlier share owner of that may have received it. You will not receive it. Some dividend means that if you buy now, then you may receive dividend, or the company may have announced that it is going to pay. So that is why this what comes excluding dividend and including. Now some classification of blue stock companies are there. More details will come in the 4th unit in valuation equity share. Some are growth companies, some are income companies, blue chip companies, speculative, cyclical, defensive, some classifications of common stock. Growth stocks are those companies which have high expected sales and earning in excess of industry average. For example, let us say telecom, just an example. Let us say 3 companies are there, A, B, C. You take the average sales of 3 divided by 3 average. The companies which have got more than the higher than the average sale, the industry average, they are called growth companies. And there are other classification also of these companies, like we look at the book value to market value. So these companies, they have got the lower book value to market value. Or P ratio, they are lower P ratio, and other like this. So because you know that the company may very low dividend or no because reinvested for expansion. And many .com companies have not paid. I gave the example of it. Income or value stocks are those stocks of older companies, and they pay high dividend. They are not because utility companies like those, and they are risk because the investment opportunities may have exhausted. So therefore they are very regular, and these companies have got the high book value to market value, P ratios, and other things, some indicators. Now, blue chip companies are those companies of very high, reputed companies. Please remember that these definitions are not mutually exclusive. A company may be the value stock and as well as blue chip stock. Good history of dividend payment and consistent earning growth. And there is very low risk of default. Speculative stocks are those stocks which have got wild gyration. There if you look low and high of 52 weeks and low and high newspapers come. So there the difference will be very large. Let us say the as low as this 10 and as high as let us say 100. So the fluctuation is 90. Very like this. The lower is the fluctuation. So we can also classify based on the speculative stocks. Naturally, these are very risky. They can go either way. It can swing between 10 to 100. Then there are some stocks which are cyclical, that they move with the business cycle. As you know, that business cycle is a fluctuation in economic activities. That business conditions undergo a change. Then the period of recession is there. Then boom period, expansion period is there. When economy recovers. So certain stocks, they are cyclical, move with the cycles. Especially those companies which are in consumer durables and others, so they are very cyclical. There are some companies which are non-durable or let us say essentials. So people will continue to buy those. And in COVID also situations like this, these companies have suffered more. The durable than the drug manufacturing companies, other companies, and other they are more affected by the. All companies are affected by this, but what I am trying to explain is that the severity of effect of these companies. So then there are defensive stocks which are opposite to business cycle. Normally these stocks are very rare to find that most of these move with the business conditions prevailing in the economy. But like recessionary condition may have less effect. Like if people are not buying the new car, then second-hand car, maybe spare parts may have a demand, automobile parts and something like that. So some are stocks are, and that there is a way of classifying is when we have done it CAPM, then there is a method by which we can know that how much is the fluctuation. For a low beta stock, I mean they're not subject to market fluctuations. The risk is less. So here only it should suffice to say that they are not affected much by these cycles, and they are opposite. It's very difficult to find such stocks which move opposite to the. But in some examples can be, like these type. When people do not buy new things, they may buy old things, and those industries may prosper. Now, with this I have covered the major part of this, but derivative securities and mutual fund I will take in my next class. Not now because you have to imbibe these things, because also if any question is there, you can ask before I close for the day. Unfortunately, only 12 students are attending the class. Okay, so I'm, attendance is, I have got a provision here in Zoom where attendance can easily be tracked when you join it, when you leave it. So this also go into, my marking scheme. I may take into account this. So we'll see in the next class. Okay.
Thank you, sir.
Thank you, sir.
Thank you, sir.